Okay, let's just dive right into this. Welcome to today's explainer. We are taking a strictly data-driven look at Genworth Financial, ticker symbol GNW. Look, if you're a focused learner trying to cut through all the noise and figure out exactly what's going on under the hood of a major financial company, well, you're absolutely in the right place. We're going to use the raw numbers, straight from the financial statements, to build a complete, unfiltered picture of where this company stands right now.
Here's our roadmap for today. First, the setup. Second, the bargain case. Third, uncovering the growth problem. Fourth, the profitability red flags. And finally, number 5, the final fair value verdict.
Starting off with Chapter 1, the setup, market momentum.
Every financial investigation really has to start at the scene of the action. And for us, here's the anchor, $9.07. That is the last closing price of Genworth Financial we're looking at today. It's a relatively modest price tag, bringing the company's total market cap to roughly $3.4 billion. But as you know, a low absolute share price doesn't really tell us much about performance on its own. For that, we need to zoom out and look at the trend over time.
And historically, the returns are honestly incredibly impressive. Over the trailing 12 months, the stock is up almost 29%. Look at that 3-year return, over 65%. And zooming out to the 5-year timeline, the total return sits at a massive 120.68%. So for stock currently trading around $9, it has literally been an absolute wealth compounder for shareholders over the last half-decade. We're looking at a stock with some serious upward momentum.
Moving on to Chapter 2, the bargain case. Screaming value?
Now, usually a stock rocketing up 120% becomes, well, incredibly expensive. But notice the dramatic gap here. The current price-to-earnings ratio is 17.11, which is fairly standard, maybe even slightly below the broader market average. But the forward PE ratio, which factors in those projected future earnings, drops all the way down to 5.11. A forward PE around 5 instantly makes this stock look like a massive bargain on an earnings basis. It's definitely an eyebrow raiser.
And honestly, the deeper we look into the valuation metrics, the stronger this bargain case becomes. Just look at these deep discount indicators. The price-to-sales ratio is just 0.48. The price-to-free cash flow sits at a very reasonable 9.30, but the most striking number here, without a doubt, is the price-to-book ratio sitting at exactly 0.40. That means the market is currently valuing the entire company at just 40 cents for every dollar of its net assets. Valuations at less than half of liquidation value are super rare, which really solidifies the idea that we might be looking at a hidden gem here.
But as focused learners, we know the market isn't exactly in the habit of giving away dollar bills for 40 cents without a reason, right? So we really have to ask the critical question, why is the stock priced so cheaply? What kind of underlying risks or, red flags are hiding beneath these incredibly attractive surface-level multiples?
That brings us to Chapter 3, uncovering the growth problem, the catch. And here is the catch. It's basically a sea of negative compound annual growth rates. Top-line revenue has shrunk by 1.35% annually over the last 3 years and over 3% annually over 5 years. But the bottom line, that is where it gets really painful. Net income has plummeted by over 28% per year over the last 3 years. Earnings per share is shrinking by 22% annually. So the reality is, the business is fundamentally contracting. Now, it's one thing for accounting earnings to drop, but free cash flow is the actual lifeblood of any business. It's the real cash left over after paying for operating expenses and capital expenditures. And Genworth's 3-year free cash flow CAGR is an alarming negative 30.76%. So the crucial point here is that the actual cash the business generates has been deteriorating rapidly. That is a major concern.
Let's look into Chapter 4, the profitability red flags, razor-thin returns. Let's evaluate return on invested capital, which is basically the master metric for efficiency. And the numbers here are shockingly low. The current ROIC is just 0.37%. Let me be clear, that's not 37%. That is less than half of 1%. Even when we look at the 3-year average of 0.43% and the 5-year average of 0.69%, it becomes incredibly clear that the investments management is making into the business are barely generating any positive return at all.
And the broader profitability metrics, they completely confirm this deep-seated weakness. Return on assets is a mere 0.25%. Return on equity sits at just 2.45%. And the trailing 12-month net profit margin is a razor-thin 2.96%.
These numbers really paint a picture of a struggling economic engine. The company is obviously having a highly difficult time turning its revenues, assets, and equity into meaningful profit for its shareholders.
Which brings us to Chapter 5, the final fair value verdict. Putting it together.
So we've seen the screaming bargain multiples, but we've also seen the shrinking growth rates and the razor-thin profitability. Running the numbers for a discounted cash flow model gives us our answer. Pitting the actual market price directly against the calculated intrinsic value, we see the current price is $9.07, while the DCF fair value comes out to $10.42. So strictly according to the cash flows, the stock is indeed trading below its inherently worth.
And this brilliantly illustrates our final calculation, the margin of safety. The difference between that $9.07 price and the $10.42 fair value gives us a margin of safety of exactly 12.98%. This number represents the cushion that's priced into the stock right now. It tells us that you're buying the stock at a roughly 13% discount to its estimated true value, providing a pretty small buffer against errors in calculation or any future market downturns.
Which leaves us with the ultimate question. The data clearly shows Genworth Financial is trading at a discount. But is a 13% margin of safety really enough to outweigh shrinking revenues, plummeting free cash flow, and frankly terrible returns on capital? You have this fantastic bargain valuation on one hand and severe operational red flags on the other. It's quite the paradox. I'll leave it to you to weigh the evidence. Thanks so much for joining me on this explainer, and as always, keep learning.